What is up, everybody? Luis here, and today let's talk about a critical topic that the mainstream media often filters, overlooks, doesn't cover, and I'm talking about the reverse repo market and the crisis it's in and its real impact on mortgage interest rates, home prices, and inflation. Now, we usually get a push-pull on rates where the headlines may read, mortgage rates have plummeted or mortgage rates at an all-time high. Well, the reverse repo or repurchase facility is a very clear indicator of what's really happening behind the scenes. And let me just say that at the end of the day, it's your 401k and my 401k that is bailing everything out. So what is happening with the reverse repo market, and why is this even important to you? Well, let's break it down. But first off, let's understand what the repo market is, okay? Now, think of the repo market as a short-term loan where banks often need cash at the end of the day to square things up, and they may not have enough. So they use something valuable like a US Treasury or a mortgage-backed security as collateral to get that cash in exchange. This is a regular repo market. In a reverse repo market, it's the other way around. Banks park their cash with the Federal Reserve in exchange for these treasuries to meet their mandates. Now, at the moment, the banks are even getting over 5% returns on this. And we're talking about 2.4 trillion. And that alone is mind-boggling. Now, here's where it gets interesting. Recently, we've seen a massive decrease in the amount of cash parked in the reverse repo facility. Billions are flowing out. Now, why should this matter to you? Well, because it's a big indicator of economic health. When the reverse repo numbers fall drastically, it signals that institutions or banks are finding better places to invest their cash, likely due to higher interest rates everywhere else. Now, this might sound good, but there's a catch. If this trend continues and the reverse repo hits zero, the government could face significant borrowing challenges. And this is crucial because government borrowing impacts everything from interest rates to the strength of our dollar. So what happens if the government can't borrow easily? Well, we might see emergency measures like the Fed stepping in or even changing how the financial system operates. Now, given the scenario where the reverse repo continues to plummet and the government struggles to borrow, we're looking at a potential catastrophic sell-off of treasuries, right? So in this situation, the Federal Reserve would be cornered into a tough spot. Now, the risk of default on the US debt becomes very real and nobody wants that. So in such case, the Fed will likely have no choice but to lower the Fed funds rate and start quantitative easing again. Now, quantitative easing, for those of you unfamiliar, is when the Federal Reserve buys government securities to inject money into the economy. This move, while it is very stabilizing in the short term, can lead to its own set of problems. Think about inflation. More money in the economy can dilute the value of the dollar. Now, for homeowners or potential home buyers, this is crucial. If the Feds drop the rates and embarks on quantitative easing, we might initially see a dip in mortgage rates, making home buying temporarily more affordable. This is short term because buyers will flood the market, and I've been preaching this for a long time. The more buyers that enter the market, the more offers, the higher the prices, especially with the current shortage of inventory. So the long-term picture could be different with potential inflation from the quantitative easing, and the cost of living could rise and affect the overall financial health. So what should you do? Well, first and foremost, stay informed. This isn't just about dry financial terms, even though it's kind of boring, but it's about understanding the potential impact on your daily life and long-term financial planning. Renters and home buyers, buy now before the rates drop and then the price of the homes go up. Remember that played out phrase, date the rate, marry the house? Well, that applies more than ever because it is a matter of time before inflation really takes off again and rent will go to the moon. But if you're locked into your home, it's not going to affect you as much. And that appreciation will set you up really nicely because you know the price of homes are going to go up. So in short, this reverse repo market crisis is a clear indicator of potential major shifts in our economy, from the risk of quantitative easing to changes in the mortgage rates and the threat of inflation. So there's a lot at stake, so keep a close eye on it. That is all I have on this video. Thank you for watching. And if you found this helpful, please subscribe. And don't hesitate to share your thoughts or questions in the comments section below. Let's keep this conversation going and try to stay one step ahead of this ever evolving world of mortgage rates and finance and inflation. All right.